Welcome back to my channel, and in this video we're going to talk about how often you should invest in the market. And this is an especially important video for beginners because how often you invest in the market actually influences your return a lot. So in this video we're going to talk about the 3 ways you can invest over time, dollar cost averaging, what that means, and we're going to go through a couple of scenarios as well, and I'll show you some things on the chart. So with that being said, let's get started. And if you don't know who I am, my name is Eric and I teach investing. So let me take you back 14 years ago to the 2008 market crash, and I'll present you 2 scenarios. So the first one is that you're super lucky. You happen to be starting to learn investing back in 2007, right before the crash, and you decide to not do any dollar cost averaging and you just went all in. You don't need to time the markets because time in the markets is better than timing the markets, right? And you just put $100,000 in the market, S&P 500, in 2007. So what happened? Well, the market crashed. And just looking at that alone, you would feel really bad about yourself, even though 10 years from now, you know that you will recover. So let me show you the chart here. So here is the chart where just in 2007, it was at an all-time high, $150 for S&P 500. So if you didn't try to do any type of averaging, you just buy it all from the get-go, you'll realize that you have a drawdown from $150 all the way to $80 or so. So that's almost a 50% decline. Now, if you have been studying investing and follow Warren Buffett or whatever, then you'll realize time in the market is better than timing the market. Because if you zoom out enough, the overall market is an uptrend. So here you can see, if I zoom out for the next 10 years, you will notice that, hey, you are making money. So then does that mean you don't need to time the market? Like, should you just buy everything from day one and not wait? And that's what this video is about. And if you look at the time here, from 2007 all the way to 2013, you'll be underwater. Even though you know for a fact that the market will eventually come back up past your entry point, psychologically is very difficult on you because for 4 years, or even more than that, 2013, for 5 years, you are underwater. And that's why timing the market is kind of important in my opinion, because it helps you avoid that emotional trauma when it comes to investing. So let me present you with the other scenario. And I just need to move myself to the upper parts of the box. So if you don't invest everything at the same time and you do something called dollar cost averaging, which is DCA, then you might only invest 20 to 50% of your capital per year, and you save some capital like a buffer for a later time when you are investing near the peak. So for example, a couple months ago, you think the market was pretty high, so you don't invest all your money. Instead, you try to save some money in case there is a crash. Now, I do talk about market crash in another video like a couple weeks ago, so you can look that up. But after the 2008 crash, wouldn't it be great if you have some cash on hand and then average down to reduce your costs? So what that does is that it gives you a much faster recovery, so then you'll see green a lot faster comparing to going all in immediately. So what I mean is actually quite simple. So here you can see back in 2007, it was $150. If you went all in here following the conventional wisdom, your cost is $150. But if you only went in half, and then if you see a lower price like 120, you try to buy a little bit more, and then 100, you try to buy a little bit more, and then once you get to 80, you're fully invested, which is a very ideal situation, then your average price is really the average between 80 to 150, which is close to around 110 or so. So that means you will get a faster recovery. Maybe just 1 year later, you'll be positive again. And then I think emotionally, you will feel a lot more confident that way. So let me reset the chart. So what is dollar cost averaging? It means you're not buying your entire position at one time. Instead, you're trying to separate your position into time periods or price points so then you're able to achieve lower volatility in your portfolio. So when it comes to dollar cost averaging, I don't necessarily think it achieves lower volatility, even though that's like the textbook objective. I think what it does is it lowers your cost base. If you're investing in the S&P 500, dollar cost averaging will still give you the same volatility in your portfolio, like the fluctuation, but it just allows you to average down because you have some buffer room. So the key benefits is that if you feel like you're unlucky when it comes to investing with timing, then dollar cost averaging will solve this problem by letting you buy at a later time instead of going all in. So if you ever feel that every time I buy, the market goes against me, which is a very beginner thing to feel, then you want to look at dollar cost averaging, because if you buy, let's say it's a good quality stock, the market goes against you and you have additional money, then you can get in at a cheaper price. Now, we'll talk about some of the problems you run into when you're dollar cost averaging down shortly in this video. So before we go further, if you're wondering, this chart and this website I'm using, it is tradingview.com. This is the chart I'm using. So if you want an exact copy of this chart, then you can just go to the first link in the description, which is the 3-hour webinar, which I recommend you to watch. So then it's 5minuteinvesting.com/free case study. So you'll find a 3-hour webinar with the common mistakes investors make, one of the first modules of Investing Accelerator, which will teach you how to set up this chart for free. So don't go with the paid version, go with the free version. And then you'll also see 2 historical coaching calls where I analyze a lot of stocks as well. So if you want to set up your charts, then just do that after you watch this video. So let's talk about the most common approach to averaging is over time. So instead of buying everything you have on January 1st, you separate it into quarters or months, and then you buy it. So that really depends on how you are saving. If you like to save on a quarterly basis, that's fine. If you save on a monthly basis, that's even better. But you don't need to be too fussed about how often you contribute. As long as it's between monthly to quarterly, I think that is fine. And when you're averaging down over time, it is really the simplest method you can use because it doesn't require you to have any sort of analysis. And it's kind of similar to how your salary comes in, right? It might be every 2 weeks, it might be every month. So then if you need to budget on a quarterly basis, then just contribute on a regular interval will give you the distribution of risk over time. So you're not taking all the risk on January 1st, but you're taking the risk on a quarterly basis. So you're kind of, lowering the volatility theoretically when it comes to investing. So with a time-based averaging, which means quarterly or monthly, you're averaging without concerning about what the price is. So if you have $25 each quarter and you wanted to buy S&P 500, you just buy it. You don't worry about what S&P 500 is. It might be 150 this quarter. It might be 75 next quarter. But that's what the faith in the system is, and it doesn't require you to have any analysis because all you got to do is just averaging in month after month or quarter after quarter. Now, this works quite well if you are saving a percentage of your pay that you're trying to average down and you're averaging into an index. Because when it comes to index, it is quite difficult to time the index unless you're expecting a market crash like right now as I'm recording this video. So if you're averaging into an index, just buy on a monthly or quarterly basis. It'll be more than enough in terms of complexity and kind of maintenance. If you have a little bit more skill and you want to average into specific stocks that you selected, then that's when the other 2 approaches will be quite useful. Now, the first one is averaging down over price. Now, this is actually advertised by Warren Buffett. He recommends it that you want to save some money and kind of average down when it gets cheaper because he's a value investor. He tries to buy things when it is cheap, kind of like what I do, like you're shopping on Boxing Day. You're trying to buy discounted clothing, except he buys discounted companies and he makes money from it. Technically, you can resell clothing in Facebook Marketplace, but that's another story. So what you're trying to do when you're averaging down over price is that you try to buy when the stock gets cheaper. So you might have a target in your mind like Google is $100, and then you'll try to buy more when Google is 90, 80, 70, 60, and so on. So one of the recent examples is actually Alibaba, which is something that Warren Buffett's partner, Charlie Munger, bought quite a bit. So initially, Alibaba was $300, okay? And then it went down to $200 because of China regulation. So there was a discounted opportunity based on Charlie's analysis, of course, and he decided to buy. Now, the problem with averaging down is that you don't know how far it can go down to. So then after 2 quarters, Alibaba dropped down even more, and now it's $100, $120 or so, and then Charlie bought even more. So one of the problems with averaging down is that if you end up averaging down on a bad company, then it might not ever recover. So that is a little bit counterintuitive because if you're not familiar with fundamental analysis, then it is quite easy to burn yourself if you keep averaging down on a bad company. And sometimes you might mistaken a bad company as a good company because you think there's a lot of hype around it, but the financials and the facts do not support the company's stock price growth. So that's when most people get into trouble, is they skip fundamental analysis, so then they end up averaging down on bad companies that had a lot of hype. So for example, you think of electric vehicles, they are a great sector, growing sector, but then you didn't realize that the companies you're investing in is losing money every single quarter. Now, there are some electric vehicle companies that are profitable, but most people, they don't look at the financials, so then they fall into that trap. So the company you invested in might be losing more and more money each quarter, and they're not delivering on their objective, like how many cars they're supposed to produce. So the share price tank, and they're not able to raise any capital. And they're not able to raise any debt as well because they're losing money. So then the business eventually declare bankruptcy, and you lose a lot of money by continuously averaging down. So let's say, this electric vehicle stock was $100, and then you bought it, went to 75, you bought it again, went to 50, you bought it again, it went to $10. So then if you didn't average down, then you would have just stopped when you first invested, and you didn't have to keep adding more and more money and increasing your loss position. So that's why if you are planning to average down, which is what most people want to do because you're trying to buy it cheaper and cheaper, you need to learn how to do fundamental analysis. If you don't know how to do fundamental analysis, if you can't tell the company's financials is good or not, then you will eventually end up averaging down on a bad company. As a CPA, I look at the financials every single time when I invest. In fact, just opening the income statements will probably tell you if this company is good or not. It takes less than 5 minutes, so you should definitely learn how to do it and learn some shortcuts to it so then you don't get blindsided by fundamental analysis and investing in a bad company. So let's talk about the third approach to averaging, is averaging up over price. Now, this is a little bit more counterintuitive because most people, they don't want to be averaging up because it requires you to buy the stock price at a higher and higher price. So for example, you might be buying Google, and Google today is $100, and you buy it again, $110, $120, $130, so on and so forth. So then your average cost is actually going up. But here's the counterintuitive observation. When you're looking at long-term investing, like long-term, like 5 to 10 years, you eventually want to average up if you invested in a truly great company. And if you invested in Apple, Google, Amazon, then you don't really get to buy it at a discount that often. So if you really want to keep the shares and continue to increase your exposure to it, then you want to be buying at every single dip. But every dip you see, it's also higher than a previous dip. So then end up your price will be going up like this. So let me just go back to the chart here and show you what I mean. So let's say I use Apple as an example. Now, if you don't know how to read a candlestick charts, I can turn it into a line chart for you. So I can just hide all of these things for now. So even without the indicators, you can see what's happening. So let me just change this to a line chart. Okay. So you can see this is Apple's price for the last 5-6 years or so. If you buy every single dip, even if you're off, you'll see that your average price is going up, right? So if you're truly investing in a great company, then your average price should actually be going up, not going down. So I think this is actually a very counterintuitive observation that you need to make as an investor, is that if you're long-term investing, you want to be averaging up over time if the company is great. So here I'm not talking about using options. I'm not talking about using anything advanced yet. This is just simple buy and hold. And that's what you're trying to achieve. Now, let me give you another example that I think would help you. So one of the popular stocks recently is Enbridge. So if you don't know, Enbridge is an oil and gas company, and right now oil price is at almost $100 because of the Russian-Ukraine tension and the shortage of natural gas in Europe and China. So if you look at Enbridge, okay, for the last 10 years or so, if you average up, let's say you started with $30, you average up all the way to $50, and it just comes back down and it just kind of ranges in this $30 to $50 mark for 10 years. So if you invested in a company that the stock price itself doesn't grow, it doesn't get you anywhere. Like you might get some dividend like 8% or 6% or whatnot, but the stock price itself doesn't grow. So then even if you do all the averaging in the world, average up or average down, it doesn't matter because the stock price itself doesn't grow. So then it doesn't help you in getting to retirement faster. So that is actually one of the downside of averaging up, is that you need to be quite confident in the stock pick that it will be going up. Okay? Now, another important observation is that let's say you start averaging Google 10 years ago, and it would be averaging up, right? So you start from $100 and now it's $1,000. So you keep averaging all the way until today. Your entry price will be the middle point of this trend. So in fact, it will be approximately $500 or $550 to be more precise, will be your average entry price. So that means if Google encounters a market crash like 20-30% drop, you'll still be above water, you'll still be green, but you might experience quite a large drawdown or whatnot. But it is still good to know that your average entry price will be the middle of the stock price, assuming you do it very consistently. So if there is a giant market crash, like 50% drop for the stock you invested in, then that's when you encounter a problem like all the gains you made for the last 5 to 10 years, are gone temporarily if you exit at the bottom of the crash. So that's why if you encounter a market crash, you don't want to be exiting all of your position at the bottom, because then you just lost all your unrealized gain and you just exit at break even. So that's also something you need to kind of pay attention to when it comes to investing. So when does averaging up works? It works quite well for index that has a strong trend. It works quite well for strong trend stocks like Google, Apple, Amazon, but it doesn't work well for something like Enbridge where there is no trend. So yeah, if you average up on a stock that doesn't grow, then you'll end up not making money, which is what I have written here, because price will go back to the mean, which is the average price. So for Enbridge, it will just be around here, this $40 mark. Okay? So one of the examples that I also want to talk to you about is tech resources. So if you look at something like tech and you zoom out for the last 20 years or so, you'll find that there are large commodity cycles that govern this stock. So even though Teck Resources is one of the largest mining companies in the world, based in Canada, the company itself is very strong, but the stock price does not present you with a strong enough trend for you to continuously averaging up. In fact, some years for Teck, you'll find yourself experiencing a large loss due to commodity prices falling. So let me just go to Teck Resources to kind of give you a sense of what I mean. For those of you who are based in Vancouver or Canada, you'll probably know Teck Resources. I'm sure our friends in Quebec will also know. And here you can see this is the stock price for the last 15 years or so for Teck. And you can see Teck ranges between $5 to around $60. And you can see that there are some large commodity cycles that are driving Teck as a mining stock. So even though the company itself is very strong, you still get these wild swings. So I have made 100% twice on Teck now, and it's all about getting in at the right time without using dollar cost averaging, because this is not a stock you should use dollar cost averaging for, because eventually you'll run into this commodities bear market where if you keep averaging down, even if it recovers, now it's only at the mid price of this giant super cycle. So what you want to do is when you realize Teck is at a very cheap price, for example, I previously bought near 7 and I bought around $10 here if I remember correctly. So both times once I made 100% using shares alone, then you just exit. You just take the profit and you invest in something else. Now you might be wondering, hey, Eric, I see that is at 35 now. Shouldn't you have held on and chase and chase and chase? Technically, you can, but when it comes to my risk tolerance, I'm pretty happy with 100% return on Teck Resources. So then I don't feel like I need to exit at the absolute high. So, and when you try to exit at the absolute high, you also run the risk of the stock coming back down. So here you can see from 2018 back to 2020, Teck Resources going down. So that's why you want to exit when you're happy with the profit. Okay? So if you're good at timing, then you can make 100% from Teck Resources, even if it is not a stock that is good for averaging up or down or averaging at all. So yeah. Now in this video, I also want to give you a bonus tip on hedging. Now, one of the things I teach in Investing Accelerator is hedging, and I keep repeating this because it is quite important this year to learn hedging, especially when the market is difficult. For the last 2 years, you don't really need to learn hedging because the market was easy. The Fed was printing money, interest rate was declining, there's a lot of money in the markets, kind of like rising the stock up. But this year is a little bit different. It's more difficult, and it's almost safer if you just hold cash. But if you want to invest and you have no strategy, you haven't done your research, then you'll think the market is very unpredictable. Now, even as a seasoned investor, I still think the market is unpredictable, which is why hedging is important. Now, for example, I can explain or at least understand 80 to 90% of the market movements. It's not random, it's driven by something. You just need to do the research to understand what it is driven by. It's only something surprising that happens in the future that may caught me off guard, which I do not know today. So for example, earnings can be something that is surprising. But I generally have a good idea on how prices move and how they correlate with each other. So for example, do you know what happens when inflation is high and how that would impact gold prices? So there is actually a relationship there. Do you know what happens when the interest rate increase and how that would impact technology stocks? There's another relationship there. And how does the China trade war impact the stock market as well? There's also a relationship there. And if you have these insights or these understanding of these relationships, then you'll be able to explain maybe majority, like 80% of the movements. So the remaining 10% of the movements that cannot be easily explained is when you need a hedge. So for example, the company released their earnings every quarter and it is quite unpredictable. And I'll explain how to work on that in a bit. But that's when you want to use a hedge, because the information about the earnings is not released ahead of time, so you wouldn't have the foresight to know if the earnings is good or bad, and you want to hedge against that risk, so that's why you use a hedge. So you might think that the market is quite unpredictable right now, so you want to protect yourself from a potential downtrend or a downward move. So let me give you an example. So recently, Facebook is one of the FANG stocks, and it used to have a very strong uptrend. Look, if you do dollar cost averaging, your average price will in fact be the middle here, which is $200. And after the earnings, it dropped from 300 to 200 something. And now, if you have been dollar cost averaging into Facebook, all your unrealized gains will be gone. So if you zoom back in, this kind of downward move, where you can see it went from 300 to 240 to now 200, is what you want to hedge against. So that is really the risk. Even for a strong company like Facebook, where they're growing 10-20% every single year or more, there can be these kind of downward moves that suddenly bring the stock price down. So that's why hedging is important. Okay? So for hedging, one more tip would be that you want to do it for a very specific time period. And that requires you to have the insights to kind of track the markets on a weekly basis. And you want to use a very small amount of capital to give you the most bang for your buck. So you want to hedge maybe 50% of your losses or more by using a very small amount of capital, so then you protect your positions. So here is the bonus tip, which is about earnings and unpredictability. So most people struggle with earnings. Okay, so if you're trying to average in or trying to buy at intervals, here's how I think about earnings if you want to prepare for them. So I struggle with earnings too, because it is quite difficult to know what it does ahead of time. But I try to reduce my losses even if earnings go against me. So in a sense, I kind of play both sides, so then I know I can be profitable in the short term either way, and in long term I expect the stock to go up. So here's how I think earnings work, and there's mainly two components to it, is the actual earnings for this quarter plus the future outlook. So there's two parts to it. So if they have good earnings and a good outlook, which is the forecast, then most of the time it will go up. There's really no reason for it to go down unless they, said something stupid. If they have a good earnings and bad outlook, meaning they did very good this quarter, and then the next quarter they think, oh, we're not going to be doing so good, it will go down. Like, I have seen it so many times when they have the guidance and it missed the expectation of what Wall Street is thinking they would do, the stock will go down like 10-20% easy. If they have bad earnings and a good outlook, most likely it will go down as well. But if the CEO is not very convincing, it will go down. If the CEO is very convincing, then it might go up. So it's more like a 50-50. But then if you think they have bad earnings, the good outlook is just a story created by the CEO to convince investors, right? Like, it's not like they did it. It's just the plan going forward. So this can include, restructuring plans, like turnaround plans. It really depends on whether the CEO is able to convince the investors to stay in the stock. Now, here's a special situation that I've got burnt a few times on, is good earnings, good outlook, but they changed the CEO. So that is usually a huge red flag, which I also teach in Investing Accelerator, is that it will go down. And to be honest, you wouldn't be able to know ahead of time that the CEO is going to get replaced. You're not going to know that the CEO is going to step down, but then you'll try to do your best to invest in good management team. Or if you see that the CEO is changing, then at least you should wait and avoid that stock for a little while until it stabilizes. So during COVID, it happens to quite a few technology companies where the CEO and management change. So you probably heard of the Great Resignation. There is also that change for upper management as well, because people are retiring during COVID. So it happened quite a few times. So if you ever encounter that situation, make sure you either avoid it or wait a little longer. So that is why earnings is tricky, is because some investors will wait till earnings is over to invest. Some investors who are smarter and they can work out whether the earnings is good or bad before they get released will invest before earnings. So you wouldn't be able to do this every single time, like to know whether the earnings is good or bad. But if you do enough research and you analyze the company, the environment, so on and so forth, you will know whether the earnings this time is good or bad. And it's really tricky. It's not easy to do. But with enough research, knowledge, techniques, you can achieve it, sometimes. I wouldn't say most of the time, because it is still very tricky to do. So that's why you need to learn hedging when it comes to earnings. So if you're interested in learning more about Investing Accelerator, then Investing Accelerator is really the 4 weeks training program I offer people without any financial background to master investing. So we cover 2 strategies in there, which is long-term stock options to multiply your return, and as you get closer to retirement, monthly passive income as well. So in my opinion, as you progress through your investing journey, you'll need both strategies. One for long-term investing to compound in your retirement accounts like Roth IRA, TFSA, RRSP, and another one for monthly passive income generation to replace your income so then you can retire or achieve financial freedom as quickly as possible. So if you're interested in learning more, then you can watch the 3-hour free webinar, which is on the link 5minuteinvesting.com/free case study, or it's just the first link in the description below, so you can just click on that and register for it. So you'll find a 3-hour webinar with some common mistakes investors make, the first modules of Investing Accelerator, including how to set up this chart. So let me just change it back to the candle and add back the indicators here. So it's very straightforward, easy to use, and I'll also teach you how to read it for entry points as well. And you also get to view 2 of the historical coaching calls where I analyze stocks and basically give you a ton of examples on how I analyze stocks and implement this strategy. And if you're very interested in the program, then you can schedule a strategy session with me for an interview or with my team. So then we will dive into your current situation, your portfolio, and see how you can best proceed forward. And if you are a good fit for the program, then we will accept you. And once you join the program, you will have access to all the materials immediately. And most people, they will take around 4 weeks to go through the program, 4 hours a week. Once you learn the strategy, then it's around 1 to 2 hours a week, which is quite reasonable, especially if you're working full-time. So as you go through the program, you'll probably have questions as well. So that's when you can ask me through email, text messages, or within our community as well. So after you go through the 4 weeks training program, then you can start looking for your first investment. So that's it for this video. And dollar cost averaging is really important, especially when you're thinking about the 2008 market crash scenario. If you don't have dollar cost averaging, then you'll be stuck at a very high price. If you have dollar cost averaging, then you're able to buy some after the crash, which will help speed up your recovery. Now, when you're looking at this example, you can actually take this example and bring it back to today. So let me just go to SPY for you. So here you can see SPY was at 400 something, almost $500. And right now it is going down. The federal government is increasing interest rates, so it's likely that the market will have a correction. It might be more, it might go to 400, it might go to 300 or whatnot. So then you want to save money to have that buffer room and protect yourself this year, because this year is the year you need to play very defensively. You want to make sure you're buying stocks that are at an absolute discount. You want to buy stocks that have very strong financials. You want to buy stocks that basically have all the ducks lined up in a row. So then you're buying the best possible option. You don't want to be playing high risk plays because money, the liquidity pool is shrinking. So then you don't want to take on too much risk because other investors will be fleeing those high-risk stocks and move onto safer stocks as well. So that's what I think will happen this year. So make sure you invest safely. And if you have any questions, you can leave it in the comments below. You can, let me know. Oh, and one more thing. Don't forget to subscribe and like this video. I'll see you in the next one.